Hi, my name is Oscar, and this is my evaluation of the AmplifyMe quantitative market making simulation. AmplifyMe highlights that this simulation aims to provide valuable insights into your strengths and areas for growth. I believe it aims to do this through testing and further developing skills in decision making and the application of market making concepts in a fast-paced, fundamentally relevant simulation. This simulation displays the benefits of quantitative market making through the struggle of maintaining efficient strategy manually. Quantitative market making typically involves the use of algorithms and mathematical models that allow them to provide improved efficiency and often automation in creating optimal spreads. This is highly relevant in the finance industry, especially in this age of high technology and information. And these market makers are able to provide substantially better liquidity in these markets and reduce spreads further. This allows assets to be traded more frequently, easily, and at better prices with minimized implied transaction costs. It also improves price information, which is critical to risk management. This simulation involved playing two different roles that interact with one another, involving market makers and fund investors. For the market maker role, our objective was to provide liquidity and help reduce the large spreads faced by investors, while making a small profit and maintaining a hedged position. In order to do this, I had several tasks, which started with setting the quote bands for each stock. These defined the price premiums that I was willing to buy and sell at, and how competitive my offers would be. However, my main task was interacting with hedge fund investors by offering large trades for increased spread profits. Simultaneously, I also had to minimize my net exposure to manage risk and ensure that I solely profited from spreads with market neutrality. To achieve this, I would trade the very liquid market fund to balance out my positions from market making. In practice, market makers similarly provide continuous two-sided quote bands to supply liquidity to other market participants, just as we did. Typically, this is done using quantitative algorithms to increase efficiency instead of manually like we did in the simulation. Professional market makers also generally aim to stay market neutral and often using broad market instruments to hedge their exposure. I think this accurately mirrors the way I managed risk in this simulation. As a hedge fund investor, our main task was to try and efficiently invest as much of our initial capital as possible to achieve a strong balanced return. The difficulty with this was trying to achieve volume in my trades to increase exposure without incurring the large cost of spreads. This created the necessity for market makers. As an investor, I also monitored news updates as well as stock prices and graphs. These provided the insight into which stocks were likely to rise or fall, allowing me to make further profits if I was able to act efficiently on this information. However, the way we contacted market makers directly for large trades reflects common practice, where many large trades are done over the counter to minimize market impact, speculation, and significant implied transactions costs. This simulation demanded a lot of ability to work under fast-paced, stressful environments where time was needed to be used efficiently to perform well. I experienced difficulties with this at the start, specifically in efficient communication. For example, when contacting market makers at the start, most of them wouldn't reply to my requests or simply take too long to offer trades. This wasted a lot of my time and often led to missed opportunities. To solve this, I adapted by identifying the most reliable participants and focused communication and relationship building exclusively on them. During the simulation, I was also able to display skills in recognizing market trends. An example of this was when I noticed a stock that struggled to fall below a certain price level, similar to what was mentioned in the initial information summary that we were provided with. To act on this, I decided to communicate with my most reliable market maker and ask him for a very large volume to buy the stock at a time of my choosing. I then waited for the stock to do poorly and approach this price before messaging the market maker again. Due to our maintained communication, he was incentivized to quickly offer me a large trade when I needed it. He was rewarded with a fair spread at a very large volume, and I was able to buy at a great price. This example highlights the benefits incentivized through teamwork and effective trend analysis in the simulation. Also, after the simulation, we were given a glimpse into how we can amplify these skills in Python in quantitative market making and how we can automate methods to improve our time management and overall efficiency. I thought this simulation was quite eye-opening in terms of the complexities and operations of real-world financial market dynamics. I feel like my main strength I was able to show towards the end was my communication and relationship building. I was also able to problem solve and effectively adapt to difficulties by figuring out the method of communication that worked best for me. I was also able to make one or two correct predictions based on my analysis of price data. My main areas of weakness, however, were to do with composure and speed. I found the experience quite stressful with the multitude of variables and decisions that we had to make simultaneously. This often meant that I did not make optimal decisions or I missed actions that I should have made, resulting in increased risk and often losses. During the simulation, I got a glimpse into how these markets operate, what skills are needed, and how all parties are incentivized to trade with one another. It gave me a realistic look into how I perform under pressure and how I can grow into a more effective, data-driven professional. It is likely that I'll have some sort of client-facing role where stress and pace need to be managed. Under this type of role, the skills of time management, market analysis, and effective communication this simulation has highlighted are likely critical. Overall, the simulation was interesting learning experience that proved to be relatively difficult. It highlighted my shortcomings in efficient time management and proficiency under stress, but also provided insight into how market makers can profit and operate spreads and how they manage their risk. I think I was able to show some strength in my communication and relationship building, which is a crucial skill needed to work with customers in finance. It is something I'll strive to further improve, and I believe I can do this through more exposure to similar environments and experiences such as the simulation.